Okay, good afternoon, everyone. Welcome to this afternoon's webinar. My name is Bob Stone. I'm a partner and senior relationship manager at Telemus Capital in Southfield, Michigan. For those of you new to these webinars and new to Telemus, I just want to let you know that Telemus is a financial life management firm based in Southfield, Michigan. We have offices in Ann Arbor, Chicago, and Los Angeles, and we take a holistic approach to wealth management and dealing with financials, family financial needs. Today, in the in the COVID-19 pandemic has really slowed our global economy, the national economy, and we thought it would make sense to bring leaders together on several different webinars to kind of discuss what's going on in the world. So today, we've decided that we should take a look at the commercial real estate industry and see what's happened, since the commercial real estate industry is not immune to the effects of the pandemic. Developers are seeing their permits challenged, permits slow down, construction delays have caused problems and reduction in operating income. So we thought we would bring a couple experts in today to kind of discuss what's going on both locally and nationally, both on the real estate side as well as the real estate finance side of the industry. So with us today, we have Dennis Bernard. Dennis is the founder and president of Bernard Financial Group and Bernard Financial Servicing Group. Bernard Financial Group was founded in 1991 and has grown to the largest commercial mortgage banking firm in the state of Michigan, financing an average of over $1 billion each year in Michigan in commercial real estate. Over the last 33 years, Dennis has specialized in both debt and equity placement with commercial lenders and institutional joint venture partnerships. Bernard Financial Group is also involved in commercial mortgage servicing on construction and permanent loan portfolios. Dennis holds a BA in finance from Miami University, as well as an MBA in finance and strategic planning from Case Western Reserve University. Also with us is Mark Woods. Mark is the Chief Operating Officer of Signature Associates, a full-service commercial real estate firm. Mark has over 30 years of management and corporate real estate experience. Prior to joining Signature Associates in 2005, Mark served as the managing director of Cushman & Wakefield's Detroit office, where he managed all the brokerage, asset management, market research, capital markets, and client solution activities. Mark holds a BA from the University of Michigan, and he is the past president of the Commercial Board of Realtors and is a member of the Board of Council Advisors for Michigan Economic Development. Welcome, gentlemen. And with that, as we discussed earlier, both of you are kind of going to give an overview of your worlds. So with that, we'll do age over beauty, and Mr. Bernard, you can go first.
I'm confused. You said age over beauty?
Mm-hmm.
All right, I better sit up on top of my wall to be as tall as Mark then. Okay, let me give you a quick overview of what's going on in the capital markets right now. First, I'll talk about who's lending and what kind of loans they're looking out there. What applies in Detroit is national. This is all national. And then I'll also talk about what kind of modifications, if any, and how lenders from different groups are handling the current COVID-19 pandemic. Our national industry does a survey every week, and about 75% of all lenders, whether they be life insurance companies, banks, CMBS lenders, debt funds, agencies, are participating. So we have a pretty good feel about who's lending right now. It's been actually the first time we've really become this concise as a group. The focus continues to shift from new loans for lenders. They're working on their portfolios and their existing book of business. So they've shifted a lot of their personnel over and their focus over. So volume in lending is down about 80% to where it was last year or even 2 months ago at this time. So new demand has slowed dramatically compared to last year. And quotes on commercial multi-mortgages are sporadic at best. Let me break down some of the differences in the capital sources. The agencies, which are Freddie Mac, Fannie Mae, and HUD, remain extremely active. They are still lending. What they're doing though is they've modified their programs. Their rates are good. Their rates blew out. Everybody's rates blew out initially in the first few weeks of March, but as April has moved along, rates have come back in many cases, and certainly so for agencies. You're looking at 10-year and 15-year money for Freddie and Fannie, somewhere between 325 to 375. The difference is right now, if you're going to do an agency loan, they're looking for at least 1 year, 6 to 12 months, mostly 12 months of interest reserves. So if you're doing a new loan, in the past, you didn't have to put up an interest reserve. Now you have to do, so you can work through any rent roll issues that might transpire over the next several months as we come out of this. So Freddie, Fannie, and HUD are still lending. They just have the reserves. Their rates are good. Many life companies are quoting across the board among various variety of properties. The properties that you can really get done with the life insurance companies are multifamily, multi-tenanted office and industrial. Retail is very difficult. If it's retail, it's got to be food and drug anchored, which makes a lot of sense since they're still open, and a fairly small amount of shop space. But the life companies are lending on well-anchored, well-located properties. They love industrial. They're satisfied with office, and their rates are anywhere from 3.25% to 4%, depending on the loan size. Unlike in the past, though, when you go for a life company loan, if the life company lender likes it, they're quoting aggressively. If they don't like it, they're not even quoting at all. Usually in the past, they might give it a weak quote. They might structure around it. So right now, they either like it or they don't. Banks, right now, even though many banks say they're in the market, they're really not. They have been just inundated the last 3 weeks with the SBA PPP 7A mortgages. So they've really literally brought all their real estate lending staff over to work on the SBA loans. So banks really are not lending. If they need to be there for a long-term customer, they're stepping up, but otherwise, right now, they're pretty much on the sidelines till they get through the SBA and see what they've done in their portfolios. CMBS, for the most part, up until early this week, for the last 5 weeks, were inactive. But this week, they're starting to shake off the doldrums and come back out. There's about $12 billion in the pipeline nationally. And as always happens when the proverbial hit the fan about 5 weeks ago, they all rushed to market to unload $12 billion in paper. And of course, none of it moved. Spreads gapped out 300, 400, 500 basis points. They've slowly started working things through. Some securities are going off this week. So we're starting to see CMBS lenders quote again. In fact, we actually signed up 2 CMBS loans this week. What are they looking to do? Typically, CMBS before this happened, they were around 70 to 75% LTV. Now they're 65 to 70%. So their leverage levels are down a bit. Their spreads blew out, but have come back in. So you're looking at rates between 4 and 4.5. But they are willing to do real estate that does not always fit into the life company, and they're willing to do longer AMs. The other thing, just like the agencies, they're putting in funded interest reserves. So what's getting financed right now? Multifamily, industrial, office is the most quoted. Retail, got to be food and drug anchored. Lodging, hospitality, not at all. And this continues to be a day-by-day thing. We might see more come back as we start to open up across the country. Some states, more so than Michigan, are starting to open up already. So we might see as they come back and tenants start to pay their rent, more lenders come back in the market. All right, let's switch to the dark side now. What about what are doing on modifications? When they passed the CARES Act and the regulations, Congress gave banks the ability to waive some of their regulations so that banks are able to modify loans a lot easier. In the past, when a bank would modify a loan, they would have to reclassify it as a troubled asset and therefore put more reserves against it, thus make it very expensive and painful for a bank. For the next 3 months, banks have gotten a waiver so they don't have to reclassify. So banks are able to give out forbearances. Forbearances mean You don't have to pay your principal or make your principal or interest payments. And so banks have been able to do that in certain cases. What about life companies? Well, it turned out Congress forgot about life companies, which are only 40% of the loans across our country. So they kind of forgot that segment. And so they have not given the life companies any kind of true relief. So again, making it very difficult for life companies to modify or forbear on loans. What a lot of them are willing to do to help borrowers, they're willing to give out 3 and 4 month forbearances on principal payments. So they are going to interest only. So, you know, our firm, we service about $4.5 billion in loans. We've been able to get about 15 or 18, somewhere around there already, in life company forbearances where they've gone interest only. And this has helped because it lets the owner or the developer, the landlord, go back to his tenants and say, okay, you pay me partial rent, you know, just something to keep going. And then what happens, it has to be made up later once the world comes back together again. The missing payments will be made up. So the life companies are, even though they're not getting a lot of relief, they are doing a lot of interest-only loans. Agencies, they came out and they thumped their chest, the federal government thumped their chest, said if you know, any landlords, if you don't evict any tenants in your apartments, you don't have to pay your principal or interest for 3 months. That sounded great. Then the details came out. We always know devil's in the details. If you take the 3 month forbearance, it does say though, after that, you have 6 to 12 months to pay back the 3 months that you did not pay or waived. And landlords are figuring out, where am I going to get that extra money to pay back? If I let my tenants not pay for 3 months, are they really going to increase their rent so I can pay back? So it wasn't as good of a workout as everybody thought. So some are taking it, some are not. And then there's CMBS, which can be, when it comes to servicing for CMBS, that is a 4-letter word. I see you shaking your head, Mark. You know, it's CMBS is tough. Although this time they finally are getting it right. They've bifurcated how they're doing it. They've made it 2 events of servicing. If you need a very minor modification to allow you to make short-term modification to your leases, or you want to use some of your built-up reserves for your debt service payment, you do not need to be transferred now to the special servicer, and that the primary servicer, which Bernard Financial is, we're allowed to make that decision and say, fine, short-term modification to give some of your tenants relief, and we'll take money from your reserves to make your payment, to help support your payment. Then the other is, if you need a bigger loan modification or true forbearance, waiving of payments or principal and interest, then it does have to be transferred to the special servicer. And then the special servicer is going to, unlike in the past, in the last meltdown, 2008 to 2010, you had to miss 2 payments to get transferred to the special. Now they are transferring you to the special if you have that request, and they're moving them along in anywhere from 7 to 10 days. Once it gets to the special, they're not staffed up to meet this demand, and they're trying to get through them in an orderly triage kind of who needs it the most fashion, but it's going to still be a very slow transaction with the special, and you'll have to go through all the fees that are associated with the special servicer. So that gives you a general overview. The industry wasn't staffed for this kind of modifications. They've taken a lot of their production people and moved them over. Banks have been really good at it. Life companies have been decent at it. And agencies sounded good, but not as good as you would like. And CMBS, if it's just a minor tweaks, have actually been really, we've done several of them already, have become really helpful. If you need a big overhaul or a forbearance on CMBS, going to take time. Mark? That's a general overview of the capital markets.
Thank you, Dennis. Mark, before we get started, we're going to open this up on the back end of Mark's conversation to questions. So if anyone has any questions, there's a Q&A button at the bottom of the screen. Go ahead and click on it, type in your questions, and I'll start reading them out when Mark is done with his comments. Mark, go ahead. Thanks, Dennis.
So I'm actually going to start with a question to Dennis, because Dennis and I went on a presentation about 60 days ago together. And it was a pitch to a large corporate user who owns an asset here in southeastern Michigan. And essentially it was a refinancing or financing pitch. Side by side with that was the other alternative, which basically would have taken the building to market to sell. Dennis, how different do you think that pitch is today economically than 60 days ago?
It's a great question. It's a great question, Mark. Cap rates are clearly going to be affected by this. And I'm not sure any of us know what those cap rates are going to look like. Interest rates are going to, when this is over, interest rates will continue to be low for financing rate. But does the cap rate come up because of different concerns in the dynamics of the market? For instance, office space. Are people going to want, when you're looking at office, you have a yin and a yang. You have one side that says people have worked effectively to some degree off-site for the last 4, 6, 8, 9, 10 weeks, however long it is. So does everybody need to be in expensive office space? The flip side is you have people, over the last 10 years, the trend has been to compact more people into a condensed space within offices, breaking down individual office and so forth. Are those people going to want to work on top of each other in a desk-like situation in the future? So that's the yang where it pulls out. And are they going to then, the people who work at home, are they going to spread out for those left over? So the question then becomes, I'm not sure where we're going to shake out, Mark, on where does the cap rate and the demand for office space settle 6, 8, 12 months from now? Lenders are still going to, for that kind of property, Class A, well located, there's still going to be a lot of interest with good corporate credit. There's still going to be a lot of interest.
Okay, but the cap rate could have moved 150 basis points in 60 days.
Yep.
Okay. So thanks, Dennis. I'm going to try not to say a bunch. I'm going to probably try not to get too excited about this. But 60 days ago was a different market. 60 days ago, our clients and the market, everybody was happy. The lenders were happy, the brokers were happy, the tenants were happy, so the occupants and the investors and the owners were happy. Pretty much the whole food chain. And Dennis and I sat in an office together at 27400 Northwestern Highway 36 years ago, side by side. And I don't know that I've ever been in the marketplace for this long of a period where everybody was happy. There was a lot of liquidity, interest rates are low, demand is high. 60 days ago, our clients were telling us, we need more space. We need it now. We need more space because we need more people. And our biggest problem is not space. It's how do we find someone to actually fill the tasks that we need them to perform. Manufacturing or office or technology or retail. That was our biggest problem. And I think many people on this call share the same thing. So what just happened is, to me, from a full service real estate advisory services firm perspective, was it did one thing for sure. We weren't able to tell our clients, 60 days ago, if we were at the top of the market. We know we're near the top just based on values. We know we're near the top just based on the econometrics. We know we're there, but we're not really conclusively be able to say 60 days ago, this is it, you should sell now because you're at the top of the market. Yeah, we were at the top of the market, for sure, 100%. And there's only one direction to go from the top of the market in this, our real estate cyclical process. You're at the top, then the first quarter from noon to 3 is you're trending down. And then from 3 to 6, you're going down. And then at 6, you start to head back towards 9 in the third quarter, and you think you're going up. In the fourth quarter, you're going up. We were at the top. So what this does to our market is the same thing it does to Telemus marketplace, except our market has far less transparency, far less liquidity. It's real assets that are, typically either owned and they're difficult to trade quickly, or they're leveraged, Dennis, and they're difficult to trade quickly. There you go. Anybody keeps a track of this, all these texts that are coming down my phone right now, Smile and all that stuff, you guys keep track of the ounce. So right now, all of those same clients have flipped, owners and occupiers. They've had a 60-day, we'll say it's going to be a 90-day decision-making meltdown. It's going to challenge every one of their assumptions on what their next real estate investment, disposition, acquisition from an office, like our manufacturing, we need more space, or whoa, we don't need more space. This is going to challenge essentially every decision a viable business working in the world, but just let's say Southeastern Michigan, it's going to challenge all their assumptions and will likely challenge and change their decision making. There will be people that decide to sell now based on just a simple example, a 40,000 square foot neighborhood shopping center owned by some very passive investors who are basically just looking to collect their rent checks passively over the next 5 years without interruption. That asset 60 days ago was worth $2 million. Actually, if it was 40,000 square feet, do the math, it was probably worth $8 million. But this is a smaller one. I'm kind of shielding so that small building today, based on the fact that 65% of those tenants are not going to be paying rent this month, and those investors they're not going to get cash flow this month. I think their attitude towards a disposition today is way different than it was just 60 days ago. So this affects everyone. The great news from my perspective in all of this is not the pandemic we had in 2008. It was never more complicated to be a landlord in 2008, 9, 10, 11. You had no money. The CMBS guys were slaughtering you. You had upset investors. You had no velocity. The automotive sales were in the tank. This is completely different. There is, Dennis just told us, liquidity in the marketplace. The companies that are occupying real estate, for the most part, unless they've got new recent debt, they're pretty well capitalized. They have cash. Our investors have cash. They have tremendous amount of resources to move into the marketplace right now amidst this anxiety, fear, panic activity that is going to confuse decision making. So I think right now it's going to be, I started out making the top 10 reasons why this is a good thing. I got stuck at 8, and then I got to 10, and then also I'm at 14. So I can share my screen with everybody on those later. And I just think the good news about this market is, you spend 60 days evaluating your business. And if you come out of that evaluation process 60 days into the process, I can make these changes and save 50% of my operating costs. I can make these decisions and re-leverage the property that I own because Dennis has led me to a good capital source. You sit still for 60 days and you think about all the ways you can make money in this marketplace, it's going to unleash. And the people that are the best at it, just like the people are, the smart professional people in this marketplace are going to flourish. They're going to take advantage of opportunities. They are going to be there to pick up deals that are in the queue right now that are going to get delayed, deferred, or retraded. it's going to be an exciting marketplace for prudent professionals. And it's going to be a time of opportunity, just like 2008. I mean, look what Rock did. You know, look what Quicken did. They bought it at $10 a square foot. They invested heavily. The price a couple months ago was probably to buy the vacants like he was buying is well over 100. And the properties downtown are trading at, you know, an asset with income producing revenue and good tenancy is worth more than $200 a square foot. So here's my quick predictions. I'm almost always wrong, mostly, but it doesn't matter. Here's my predictions. Office, man, it's going to be tough because all the decisions are going to lead towards virtual being better tomorrow than it was today. And then on the flip side, we're crammed into one person per every 100 square feet. So social distancing or social spacing or social work placing, it may go right back to 250 square feet per person. Who, I mean, am I right or wrong? It's for sure going to be more like operating a business within your property. It's going to be more like a hotel. And I would not be surprised if you have half a building and 25% of it, you pay by credit card per day, per hour, on demand. Could be right, could be wrong. It'll be like operating a hotel. Higher service, high quality, flight to security, flight to safety. I mean, the environment that we're in at One Town Square and Redico's property, this is where people are going to occupy space. Retail, I mean, that's a hold. Maybe you're a seller if the markets will prevail. The data right now is that office tenancy has paid. They paid April. They may or may not pay May, but the metrics are above 75%. Industrial, way over 75%. Retail, it's like 35%. So hold on there. Industrial, I think this is going to be amazing for the industrial category. I really do. Made in America, you know, if we haven't messed up outsourcing to other countries, and it wasn't self-evident and very, very obvious prior to this, just logistically and trademark infringement and communication barriers and resource. I mean, it's just going to be easier and more profitable to do. I hope the next Tesla plant is in Flint, Michigan, or Jackson. It should be, because we really botched it. So manufacturing, industrial assets, endless opportunities. Investment real estate, it's an asset, it's a hard asset. If it's an income producing asset, it's a good time to look at the values and what they represent to your portfolio, and maybe capitalize on some long-term lease dispositions now, sale leasebacks. And that's those are my predictions. And happy to take questions. I'll give you my top 10 reasons why this is awesome later.
Mark, can I double down on what a great observation you had a moment ago? I think you are spot on what we're seeing. This is very different from the 2008 to 2011. This is a short term, but this is a time for professionals to differentiate themselves, professional owners, developers to differentiate themselves from, at any time that you've had such a long expansion, you know, everybody who gets in the business to think that they are. Bob, it's no different than in your line of business. You know, you have all the professionals that like Telemus who've been doing it, good times and bad, and then suddenly, as there's been such a long expansion in the markets, everybody suddenly becomes a wealth manager.
So, you know, just unprecedented. And then on the office side, you know, I could show you the analytics on that. They've been the same since they got in the business. like $20 a square foot, 20% vacancy, $20 per square foot tenant improvement allowances, which have now tripled. Not 20% commissions, and not 20 months free rent. But generically speaking, you walk into a landlord in a building, and over the median discount from what they ask for and what you're able to get has been about 20%. So it's just 2020 for me, and coincidentally, we're in 2020.
Thank you, Mark. We have a couple questions already loaded up, so if you don't mind, I'm going to kind of launch into some of the questions. Dennis, someone wants to know if you can explain the CMBS versus RMBS markets and clarify if some of the debt has been structured and is now sitting on investor portfolios, and what does interest only or skip payments do to the structured debt out there?
Yeah, I can explain. Oh, you want me to?
Yeah.
Well, now I really
That
can't.
was easy.
I really can't. All right. Just to step back, CMBSS. All right. The way it's done, just to CMBS, lenders take and make 25, 30 loans, and they pull them all together and they put them in one securitization. And for the last 10 years, the size of the securitization is about $1 billion. They then take them to rating agencies and slice them up into different tranches, AAA, AA, all the way down to the unrated piece. And then investors buy different pieces of the debt. And CMBS, commercial mortgage-backed, stands for commercial mortgage-backed securities. And then they get sold, and they're securitized and sold in what's called a REMIC. The REMIC has, and this is getting a little nerdy here, but the REMIC has interest protection to make it a pass-through for everyone, so the REMIC itself is not taxed. In the past, and this is what's important to allow this is what has allowed people to start making some minor modifications in CMBS. In the past, if you modified too much of a securitization, loans in a securitization, that could take away the tax structure of the REMIC. So the IRS ruled last Monday that in the short term, they're able to make some minor modifications that will not cause the collapse of the tax structure for the CMBS loans. So therefore, they are able to make short-term 3, 4, 5-month modifications without affecting the REMIC or the tax structure. Also, the goal always is to try and make sure that that any modification that stays pretty much within the unrated piece, the B buyers piece, and doesn't affect any other rated tranches.
Thank you, Dennis.
So when you do CMBS lending, the risk is to move the paper, but for RMBS, it's usually best efforts on a fee. So that's why CMBS hurts, since folks are kind of hung out there. It's a little riskier.
Okay. We have another question. It says, what are the recovery rates historically on defaulted properties, especially in 2008? Gut feel on default and recovery rates in this mess. This is a 6-month. It takes 6 months to come back to normal, or is it going to take longer?
Say that again, Bobby.
What are the recovery rates historically on defaulted properties? Let's just start there. So, you could use 2008, 2009 maybe as kind of.
As Mark said, 2008, 2009, they were blown up. They were of biblical proportion. Those who could, because there was no liquidity. The big difference now, Mark pointed out, there was no liquidity.
Okay.
But lenders have a liquidity, and this time around, investors have a lot of money. That's why I wanted to come back to Mark Woods' point. Those who shouldn't be in the business that bought real estate, they're being crushed out. They don't know how to deal with having to deal with the tenants, work through, did you get your SBA loans, to, give your modification, hammer them that this is you're a credit tenant, you got to pay. If you don't do it here, we'll do it also here. It's the professionals who are being able to work it. Those people who really shouldn't be in commercial real estate, but got in because times are good, they want out right now. They want to sell. They just want to get, even though their property may not be worth, Mark, what it was
Right.
2 months ago,
Yeah.
they want to get back to what they had in there and get out of it because they don't know how to deal with this, sync with this, or to answer that question, Bob, they don't know how to make a recovery on the property.
Sure.
So we have a lot of professionals. So the market's going to bounce back fairly quickly because we have a lot of professional owners
Who will step in.
already contacting lenders.
Yeah.
I will take whatever you got, especially in industrial and in multifamily. The appetite is tremendous to take anything that they're taking back right now. So the recovery, as long as we start to come back, and even though the economy may not be full steam for 6, 12, 18 months, you're going to see the bounce back in multifamily and industrial immediately, as Mark pointed out. Hospitality, and anybody's guess in retail is going to be sporadic between the haves and the have-nots as our continuing buying changes. 2008 through 10 is not going to be reflective because right now, as I mentioned, there's buyers out there right now. And there's lenders to finance them, and there's investors to support them.
Okay. Thank
Mark,
you.
would you agree? Mark,
100%.
you guys sell and manage a ton of stuff. Is that what you're seeing?
100%.
Okay. So there's another question up here, Dennis. Last week, James Gorman, CEO of Morgan Stanley, was quoted, "We've proven we can operate with effectively no footprint after moving 90% of their employees to work from home and not seeing productivity diminish." He was later quoted as saying that his firm would be able to operate with much less real estate. Do you predict this will become a trend? Thank you.
You want me to take that, Dennis?
Yeah.
So 1992, I get down to Ford Motor Company. It's a real estate development company that I'm in the land development division. That was at the end of a period where I think we doubled the inventory of suburban office space in the prior 10 years. So in the 1980s, we doubled the inventory of multi-tenant suburban office space in North America. So what's relevant? In 1992, I get to Ford Motor Company and everybody's in a private office. There's huge conference rooms. There's zero technology. Even in the R&E centers, they gobble up space like you can't believe for a variety of reasons. I mean, the old Steelcase 9,000 workstations, I think, they feel like they were 400 square feet. They were 12 by 12. So fast forward to today, everything that's happened over the last, 2 decades has been a decline in occupancy. Well, there's been no new construction either. And architecturally and programmatically as it relates to space development usage and architectural and technology and workplace of the future. And I mean, it's been like Star Wars over the last 20 years. What happens next? The only thing for sure is people are going to use space differently. And she can say whatever she wants. It's not proven out to be effective. It's proven out to be efficient. They've demonstrated they can use a lower footprint, but how's that going to translate to their earnings and the sociability of their workforce and how they're able to actually create and produce? I think it's another decade before we figure out what's the right workplace from an office perspective. This could change the retailing dramatically. This could change the way the manufacturing assembly line works. And their distancing, for a variety of reasons, needs to be safe. Lear did something unprecedented in my career last week, and they're to be applauded. They spent the last 30 days evaluating what the safest possible reentry because they're already back operating plants, will look like in a manufacturing facility. They did it thoughtfully, they did it thoroughly, and then they published it for everybody else to see and share the best practice. That sort of sharing, if it takes place in how we're working in environments and what's actually effective, it's just going to change stuff. People are going to need more, they're going to need less. We could make another shift to nobody wants to be in the burbs, they don't want to be downtown. Who's going to be right? The decision makers on that are not going to be real estate people. They're going to be business operators.
And we
What
still,
works-
and to both Mark, to your point, not all the factors are in. Bob, what the guy from Morgan Stanley is leaving out of the equation, efficiency currently right now of having the workforce working remotely is high because of one thing hasn't factored in of human nature. Right now, there's no other distractions. There's nowhere to go. You can only binge watch Netflix and Hulu so much. But when the world comes back and you can go out and go to events, you can go outside, you can do this, you can go shopping, you this, whatever. And if they're at home and maybe not under the same confines of being in a workplace where there's more peer pressure to be putting time in, to efficiency, to getting things done, to collaboration, that's one whole factor. Because right now people have nothing to do but drink, eat, binge. Did I mention drinking? And doing their work. What's going to happen though when we open up? And that, as Mark points out, these are factors we're not going to know for months.
Okay. Mark, you're
Hey,
going to say
Bob.
something? Yes, sir.
Yeah, I just, when Dennis started talking about sophisticated financing instruments that are available in the marketplace, my ADD got the best of me, and I started to take notes on what he was saying, but instead I made a top 10 reasons that this is a pretty cool thing. Are you ready?
So go ahead and share it. Go ahead.
Number one, I will save $1,000 on Starbucks this year. That's $3 a day times 300 days. Twitter, who knew? I never used it. Zoom, who knew? Number four, online everything. That's cool. FaceTiming your boss at 5 a.m. instead of being in the office. Number one, 99 cents a gallon at Costco? Are you kidding me? Virtual workouts. No distractions in the office space. There's nobody out there. You can actually work and nobody bugs you. No hugging. I'm not a good hugger. And social workplace means more space. Those are my thoughts.
Thank you. Appreciate it. We have a couple more questions. I will remind you that we're still open for questions. I understand Dennis is a big hugger though, Mark, so you may have to hug him somewhere along the line.
I am a big hugger.
So a couple questions. One is, if the stay in place orders stay around much longer, economy is kind of at a standstill, is there a point in time, June, July, August, September, where, everything you've said basically gets tossed out the window? And, is there kind of a drop dead date that we maybe need to get activity going? And this is more of a broader question in terms of the economy, but is there kind of a point in time where it's kind of gone beyond what, is normal and probably throws out all predictions?
Armageddon.
Okay.
I was doing our simple math, and our simple math is, revenue of X, expenses of Y, EBITDA of Z. And at the end of the day, all year long, if we can make, 10% on our revenue, we're doing pretty good. Every month is 8%. Do the math. So if 3 months goes by and that's reduced your revenue opportunities by 24%, which has reduced your profit, it gets complicated the longer this draws out. And, there are some firms that the kickstart will be, will be significant. There are some firms that are in the advisory or reoccurring revenue business that they're just going to be so busy handling their client activity and trying to make sense and advise them in the right direction, that they could have rebounds dramatically and quickly. But 90 days is a long time. That's 24% of the year.
From a lending perspective, existing loans. All right, you can get through 1 month, which we did. We're barely going to get through a second month. If we go into a third month, you're going to start to see true defaults. Because Mark's right, there's only so much, you suddenly ate through your equity, your profit, and so forth. And tenants are going to start, even credit tenants, we're seeing it in retail, we're going to start seeing it in office and in other forms. They're going to just across the board say, fine, we have 500 locations, we're going to pay 50% rent in all of our locations, nothing personal. So
Yeah.
we are looking at, right now we have a lot of liquidity. Unlike 2008, our lenders have never been this healthy going into a recession, man-made or otherwise. But that's going to get eaten up rather quickly if we don't open up, start going back to work, and rents get paid and mortgages get paid. It's a huge domino effect. It will have a bad cataclysmic effect on all forms of debt and equity. So yeah, this with every month it gets tougher.
Okay, thank you. Another question
Even if
coming
we're
in.
limping along
Okay.
to try and decide what's safe and not safe is advantage over what we currently have.
Okay. Next question coming in is, do you see a geographic change, urban versus suburban, for the office space after this situation? I guess, Mark?
Well, like I said in the beginning, I'm wrong half the time. So which is it? Are we going to be less dependent on the vehicle and want to be closer to, it's pretty cool. One of the coolest things about working from home, if that's where you're at, is you don't have a commute. So if the CBD from a lifestyle, living, recreational food is fantastic down there, but also from an office space perspective, I think it drives that way. In my opinion, I think we're already directing towards more urban quality assets as being, preferred. Southeastern Michigan, it's for 20 years, nobody was moving downtown from 1990 to 2010. And then all of a sudden from 2010 to 2020, we've got people that have a need and a desire to be downtown. So, or is it the other way? They're trying to get away from everybody and they want to be in a suburban office building.
Okay.
I know it's going to be the buildings that will be downtown or suburban, the Class A buildings, the quality of buildings will be the ones that gain in occupancy and revenue.
So an upgrade in quality is something you'll see happening here across the board.
Yes. And safety and security is going to be important. So even if you're in a smaller building, your people are going to want to know, I think, who's coming and going, how are they controlled, how are they tested, how are they quizzed, and what access and where do they have access into the building.
Okay. There's a couple questions coming in on multifamily. Essentially multifamily in the city of Detroit, and you see opportunities, on the back end, given the rent's not being paid now, are there going to be opportunities for purchase or investment in multifamily going forward?
Yes.
And what about in Detroit also? You think in Detroit there will be opportunities? Because that was kind of the back end of a second question.
Yeah, I don't think it's going to discriminate territorially or geographically. Downtown, Dennis knows so much about downtown multifamily. My short answer, because I don't know as much as he knows, is there's going to be a ton of opportunity downtown.
I agree. Again, this goes back to some people, the professionals that are down there will do well and survive. The ones who were developing or they're half developed, there's going to be opportunities down there, or bought and we're trying to renovate or whatnot, there's going to continue to be opportunities.
Dennis, there's a couple.
Ground
oh,
up
sorry,
is
go
going to
ahead.
be difficult though in the city
Yeah.
because of we thought we had high costs before. We're going to have even higher. Also, another issue becomes the longer our state stays closed vis-a-vis other states. Nobody's talking about this, but the longer we stay closed, we have a tremendous shortage of subcontractors in the building trades. Subcontractor, and we got hurt because in the 2006, remember Michigan started going down early. From 2005 or 6 through 2011, 12, we had so many subcontractors and talent in the building trades move out because they get in their pickup trucks and they leave and they go find work. Good tradesmen can find work elsewhere. And therefore, then when we started to come back starting in 12, we didn't have a lot of those trades. If we stay closed and other states surrounding us start to open up, we're going to see our subcontractors leave to go do work elsewhere. And that's going to have an increase, a significant increase again in our already high cost of construction.
Okay. Dennis, there's a couple questions.
Unintended consequences.
Right.
Yeah.
Makes sense. Dennis, there's a couple questions coming through here on people who have CMBS loans and they're not having any luck finding someone to talk to help them out. So is that something, if you're not the original borrower on the CMS, is that something Bernard Financial can help out with? Or are they kind of stuck, you know, and no one to talk to? How do you kind of work through that situation?
If you had done one of the things that makes us unique is we are the primary servicer on all our CMBS loans. And since we've been doing this for 27 years, we have relationships with the masters and the specials, and we're able to expedite a lot of these modifications, transfers, and interactions. Currently, we're not helping those who are not our existing clients. We'll see in another month or two.
Okay, so you're kind of stuck for right now.
Except if you did a loan with us, you might already have your modification.
Okay, fair enough.
You're right, Woods. I'm happy.
This is going way, way back, but someone wanted to know how does what's going on today compared to the S&L crisis back in the 80s? I mean, both of you guys are old enough to remember that. Does raw land fit in anywhere in the commercial real estate lending? And is there opportunities there?
Lending?
For raw land?
Yeah.
No.
It was a two-part question. You know, does that raw land fit anywhere into the commercial real estate right now, or no? And then also, how does this compare to the S&L crisis back in the 80s?
I think I'm going to just go on the land side, watch and wait. You know, your land value's got to at least double every 5 years for it to be a worthwhile hold investment. But watch it. I think there could, again, disruption. People are sitting on land that maybe they were not sellers. So the no, I'm going to wait. They're not waiting anymore, and there might be some good values.
Okay.
And I agree with land, you know, and this is not similar to the S&L crisis. There you had we were currently in an overbuilt situation, and then we had a lack of liquidity with the collapse of the S&Ls, and CMBS really wasn't around yet, so you only had banks and life companies, so there wasn't enough liquidity in the marketplace to pick up the slack. So no, this is a different kind of situation.
Okay, thank you, Dennis. I mean, the rest of the questions are kind of similar in terms of what we've had before. We're now approaching an hour, so I don't want to take everyone's time, although most people are just sitting at home watching Netflix. I want to say thank you to Dennis Bernard and Mark Woods for helping us out and participating. If you'd like to listen or watch this again, you can go to our website and the telemus.com website and go to the Insights tab, and we will post in the next couple days a rebroadcast of this. Also, if there's any additional questions you think of after this and want them to get answered, you can email me at rstone@telemus.com, and I'll make sure Dennis and Mark get the questions and they can be answered, and I'll send them back out to you. And with that, I want to say thank you again to both of you for participating, giving us a little bit of your valuable time. and wish you luck going forward in this whole situation.
Thanks, Bob.
Have a
Thank
great
you,
day,
Bobby.
guys. Thank you.